I am Larry Fraze, owner of Fraze & Company. We're a CPA firm located in Ottawa and Naperville, Illinois. I want to share some information about tax-efficient investing. As just about every investor knows, it's not what your investments earn, but what they earn after taxes that count. After factoring in federal income and capital gains taxes, the alternative minimum tax, and any applicable state and local taxes, your investment returns in any given year may be reduced by 40% or more. For example, if you earn an average 6% rate of return annually on an investment taxed at 24%, your real after-tax rate of return would only be about 4.5%. Reducing your tax liability is key to building wealth through the value of your assets. Tax-efficient investing is important in all tax brackets, but the higher your tax bracket, the more important tax-efficient investing becomes. Here are 5 ways to potentially help lower your tax bill. Number 1, invest in tax-deferred and tax-free accounts. Tax-deferred accounts include retirement savings such as traditional 401ks, 403bs, traditional IRAs, and annuities. Contributions to these accounts may be made on a pre-tax basis, which lowers your taxable income, or on an after-tax basis. More important, investment earnings compound tax-deferred until withdrawal, typically in retirement when you may be in a lower tax bracket. Contributions to non-qualified annuities, such as Roth IRAs, do not have the same pre-tax benefit. However, earnings that accumulate in Roth accounts offer greater flexibility, and investments can be withdrawn tax-free if you meet the requirements for a qualified distribution. Now, there are a few pitfalls to avoid. One of the largest is that withdrawals prior to age 59.5 from a qualified retirement account may be subject not only to ordinary income tax, but also to an additional 10% federal tax if the withdrawal does not fall into a qualified exemption. Additionally, if your effective tax rate, that is the average percentage of income taxes you pay for the year, is higher than 12%, you'll want to evaluate whether investments that earn most of their returns in the form of long-term capital gains might be better held outside of a tax-deferred account. That's because withdrawals from tax-deferred accounts generally will be taxed at your ordinary income rate, which may be higher than your long-term capital gains tax rate. Number 2, consider government and municipal bonds. Interest on U.S. government bonds is generally subject to federal income taxes, but is generally exempt from state and local income taxes. Municipal bond income is generally exempt from federal taxes, and earnings from municipal bond investments issued in that state may also be free of state and local income taxes as well. Depending on your tax bracket, an investment in a taxable security would have to deliver up to 40% pre-tax earnings to equal the tax-exempt return offered by a municipal bond. Now, you want to be sure to compare the true taxable equivalent yield of government bonds, corporate bonds, and in-state municipal bonds. Many calculations of taxable equivalents do not take into account all the tax factors or fees charged by the broker. Additionally, income derived from certain types of municipal bonds, called private activity bonds, may be subject to the federal alternative minimum tax. Number 3, look for tax-efficient investments. Tax-managed or tax-efficient investment accounts and mutual funds are managed in ways that may help reduce their taxable distributions. Investment managers may employ a combination of strategies such as minimizing portfolio turnover, investing in stocks that do not pay dividends, and selectively selling stocks that have become less attractive at a loss to counterbalance taxable gains elsewhere in the portfolio. In years when returns on the broader market are flat or negative, investors tend to become more aware of capital gains generated by portfolio turnover, since the resulting tax liability can offset any gain or exacerbate a loss on the investment. It is important to keep in mind that taxes are an important consideration, but they should not be the primary concern of any investment strategy. They're a piece of the puzzle, but not the whole picture. Number 4, put your losses to work. At times, you may be able to use losses in your investment portfolio to help offset realized gains. It's a good idea to evaluate your holdings periodically and assess whether an investment still holds the long-term potential you anticipated when you purchased it. Your realized capital losses in a given tax year must first be used to offset realized capital gains. If you have leftover capital losses, you can use them to offset up to $3,000 in ordinary income in that tax year. Any remainder can then be carried forward to offset gains or income in future years, subject to certain limitations. Now, a few down periods doesn't necessarily mean you should sell simply to take a loss, and taking a loss solely for tax purposes is usually not a good idea. Stocks in particular are long-term investments subject to the ups and downs of the market. However, if your outlook on an investment has changed, you may be able to use a loss to your advantage. Number 5, keep good records. Keep records of your purchases, your sales, any distributions, dividend reinvestments, in fact, all your transactions, so that you can properly calculate the basis of shares you own and choose the investments you sell in order to minimize your taxable gain or maximize your deductible loss. It's easy to overlook mutual fund dividends and capital gains distributions that you have reinvested. You may accidentally pay the tax twice, once on the distribution and again on any capital gains, or you may underreport a loss when you eventually sell the shares. Keeping an eye on how taxes can affect your investments is one of the easiest ways you can enhance your returns over time. For more information about the tax aspects of investing, contact us at info@frasecpa.com. That's info@FRAZECPA.com. Now, this information is general in nature and is not meant as tax advice for your situation. Always consult a qualified tax advisor, such as Phrase CPAs, for information as to how taxes may affect your particular situation.